Hi everyone, welcome back to the Joyful Investors channel. Today I'm back with more to share with all of you new investors out there starting on this exciting investing journey. Sometime back, I had this conversation with a friend. I shared that I had recently bought the Amazon stocks because the stock prices have retraced to below its intrinsic value. But my friend had a differing view. He thinks that the Amazon stock is too expensive, which was why he did not buy the Amazon stock even though he saw that the prices had retraced to a previous support level. And I'm sure some of you out there will have given the same response as well. And I do know where you're coming from because buying a stock at a price that is over $3,000 really does seem to be expensive at first glance. And in fact, Amazon is one of the top 10 stocks with the most highest traded share price right now. Let's begin by examining two examples. Amazon stock was consolidating at around $3,000 to $3,200 for quite some time between October to December 2020. Apple stock, on the other hand, was trading between $105 to $120 for most of the time between October to December 2020. Both stocks actually retraced to a previous support level. Due to both of them being a tech stock, they have very similar stock chart shape and price movement. Let's take a vote now. Which stock would you have bought if you were looking to add some positions to your portfolio at that point in time? Do you find yourself more inclined to choosing Apple stock over Amazon stocks? Many retail investors make their decisions on which stock to buy based on the absolute trading prices. Like in our example, chances are that a retail investor would choose to buy the Apple stock over the Amazon stock because it is seen as cheaper due to the lower trading prices. But if I now feed you with more information and I tell you that the Amazon has an intrinsic value of $3,400 while Apple has only an intrinsic value of $85, making it an overpriced purchase, would that piece of information have changed your decision? Every stock has what we call an intrinsic value. It is defined as the fundamental value of the stock, or in layman's terms, how much the stock is really worth. So by comparing its intrinsic value against the current market share price, it allows us as investors to make better and more educated decisions on which stocks to buy and at which entry price to take. So this reduces our investing risk. Because if you buy a stock at a price that is higher than what it is worth for, there is a chance that the prices may tumble down anytime. Always remember that in the short term, stock market prices are driven by emotions and irrationality. Prices can hike up so much because of the hype around the stock, but it does not necessarily mean that the stock is really worth that much. And in the long term, prices may drop and correct to its true value, so there is a risk that we may end up in a drawdown position. But if you are doing trading and not investing, by capitalizing on the hype and the short-term gains, then that is a different matter altogether. In fact, Apple recently had a 4-for-1 stock split in August 2020. This means that for every one share that an investor holds, he will be entitled to 3 additional shares, giving him a total of 4 Apple shares. Correspondingly, the share price will be reduced by a quarter. Therefore, this does not change the total monetary value of the Apple stocks you hold. The stock split does not result in you gaining or losing any value on Apple stocks that you hold. But for an investor who does not understand the concept of a stock split, he may end up falling for it and buying more shares to add to his portfolio, thinking that these Apple shares have now gotten cheaper. Therefore, it is important to apply valuation methods to put a value to the stock before we buy the stock. And there are many valuation methods available. Some of these includes the PE ratio, PEG ratio, the PB ratio, and the DCF method. Each of these methods have its pros and limitations, so which method to use really depends on which stock you are trying to analyze here. PE ratio stands for price to earnings ratio. It is computed by taking the current market price per share divided by the earnings per share. Intuitively, a higher PE ratio means that the stock is more expensive because we are paying more for what the company is earning for. But if a company is earning a history of losses, then the PE ratio will not be applicable because of the negative earnings. And in such a situation, we should look to other valuation methods that are more applicable to derive at a gauge for the value of the stock. PB ratio stands for price to book ratio. It is computed by taking the current market price per share divided by the book value per share. And again, intuitively, a higher PB ratio translates to a more expensive stock. Similar to the PE ratio, PB ratio will not be applicable if the company has a history of losses with negative equity. Further, as PB ratio is computed based on the book value of the company, the management's degree of aggressiveness in accounting will directly impact the PB ratio, making it sometimes an unfair comparison between two companies. In particular, certain industries such as the tech industry that is heavily focused on intangible assets may not have their value accurately captured in the PB ratio due to the judgmental accounting estimates involved. PEG ratio stands for price to earnings growth ratio. It is computed by taking the PE ratio divided by the growth in earnings per share. So this ratio is seen as an enhancement or improvement to the PE ratio because it incorporates the future growth in earnings per share. This allows investors to put a value to the share by giving credit to the future growth rate in their earnings. But this also points to a tricky part, whether the future growth rate in the earnings is an accurate estimate. Finally, the DCF method aims to compute the value of an investment based on its future expected cash flows. So these future expected cash flows are discounted at a discount rate, which is usually the weighted average cost of capital to derive at an intrinsic value. So this method is built upon the view that the value of a business is largely dependent on the cash that its assets will produce in the future. And this is also the method that we use to compute the intrinsic value of the Amazon and Apple stock that we shared earlier on. This method allows investors to gauge what entry price to take to enter long positions of a stock. So why do I use the word gauge? That's because the intrinsic value is derived based on the inputs that we put in, and these inputs are just estimates. So such inputs include the discount rate and the future expected growth rate in the cash flows. But the fact that these are just estimates should not stop us from using valuation methods to put a value to the stock before we buy the stocks. We just have to be mindful that some of these valuation methods involve estimates and that valuation is not a stagnant concept. That means to say the valuation ratios and intrinsic value will change over time because businesses are dynamic. However, do take note that we should not just use valuation method as the sole way of screening for good stocks to buy. Whether to buy a stock is not just about whether it is fairly priced or undervalued. A good stock can be undervalued now. Likewise, a bad stock may seem to be undervalued as well. It is crucial not to fall into value traps. A value trap is a situation in which a stock seems to be undervalued based on the valuation matrix, and an investor gets enticed to take long positions of the stock. But such a stock could actually be facing serious problems such as cash flow issues or losing its competitive advantage, resulting in the declining share prices. Hence, it is always important to screen for good stocks to buy by applying a set of criteria. And in fact, the first step is to first apply this set of criteria to screen for good businesses to buy before we even move on to the next step of applying the valuation methods to put a value to the stock. We hope that after watching this video, you will now have a better understanding of what is considered as an expensive and cheap stock. It is definitely not just by looking at absolute trading prices of stocks. And if you think about it, isn't this concept similar to choosing to buy a higher priced bag that's more durable compared to buying a cheaper or a lower priced bag that gets worn out within just weeks? Thank you for watching this video, and do leave your comments. Remember to hit the like and subscribe button, so I'll see you in my next video.